In this video, I'm going to focus on how many fast-growing businesses are driving numbers and achieve results, even if they are going through hard times or exponential growth. I'm seeing a lot of finance leaders believing that if they have a great financial model, then they are able to guide the business towards better outcomes. But for those of you who wonder why this is not working for you that great, and the results are hit and miss, and most of the forecasts actually don't come true, there is a better way. I've started same as everyone. I've done probably every single course or masterclass that is available out there on finding ways to help the business see around the corners, understand better, and plan for what is coming its way. But what I found is that every forecast, every single budget that was built on a financial model was wrong. But every single budget, forecast, or plan that was built on drivers and levers influencing what people think and do in that business had completely different results. And that's what I'm going to share with you today. So once we understand that it's not the numbers that drive the business, but the actions that people take or don't, we are able to see through the numbers in a much better way. So same like you, I was taught that finance is about math. But once I found that you can't rely on financial models to predict this one variable, I realized that's actually a big problem. Because the way we are taught about money in general, about business cash flows, about the future profits, is all heavily based on math sprinkled with leadership. And because financial leadership is dealing with numbers, there's this illusion that it's an exact science. But the truth is, if it were, financial models could guide business performance and every business would grow and prosper according to its financial roadmap. Clearly, something else is at play. As a senior financial leader, you probably lean on statements of financial performance and typical variance analysis to make sense of what is going on in your business financially. And disclaimer, I do too, with caution. But today I'm going to focus on future performance. If you use your current results to forecast your future performance through standard models where you plug in data and rely on formula-based assumptions, you may recognize this situation. This works fine in textbooks, but reality can deviate wildly from those perfectly modeled forecasts. Why? Well, economics is a social science. It turns out that numbers are just the consequences of the choices people make. The problem is this. In the workplace, particularly in finance departments, we continue thinking mathematically and logically. Unfortunately, nobody taught us how to deal with the fact that money flows are not logical. They are neurological. In other words, what happens in the finance realm isn't driven solely by formulas. It's driven by people in their behavior. And it's easy to get confused because you're still dealing with large sample sizes, statistics come into play, but statistics is a precise mathematical science, but it involves assumptions, and it does come with inherent margins of error. If you come across Philip Tetlack's famous super forecasting research, it proved that even top experts struggle to predict human decisions accurately. His studies show that most forecasts are only marginally better than random guesses when it comes to human behavior. So what we can work with is the probability of possible outcomes in statistically significant sample sizes. It's a mouthful, I know, but this means that if you have enough data, you have an indication of what the probability of your desired outcome is likely to be. With that, you can see more reliable dependencies between the result drivers and the probability of the possible result scenarios. But the probability changes when circumstances shift. So the key challenge in projections is that they often assume stability. And we know that human behavior is one of the drivers of the future results that can shift unpredictably. So on top of that, the human factor is also embedded in the formulas as assumptions to get the forecasted result. But if your historical data no longer mirrors your current environment, or your teams respond to new pressures, the probability of these desired outcomes can drastically change. So if you keep asking, why are we always off on these numbers? The most likely answer is the people and their choices simply don't follow your formulas. Now, it's useful to remember that most situations have never happened before. History repeats itself, but not soon enough, and often disguised as something else. And math has limitations where there is no data. So the only way forward is to combine the logic from the exact sciences, where formulas apply, with behavioral science, where we understand how people are wired to estimate the likelihood of their choices. So if you are a senior leader in an organization where each quarter feels different, you understand this well. This is exactly what is happening in growing businesses. Each quarter is different to the previous one. Why? Because things changed, volumes changed, markets potentially changed, the mix of players potentially changed. So here's the good thing. The formulas still apply. The bad thing is formulas change. I'm going to give you one example. It is an observation that significant changes in a company's operations often occur when the number of employees reaches multiples of 3 and 10, like 10, 30, 100, etc. Even small changes in the market, team morale, or leadership priorities can undermine your assumptions behind your growth milestones. In other words, purely quantitative approaches aren't enough. Every missed revenue target is not just a numbers issue. It's most likely the failure to understand human decision-making at various parts of the company's business model, the current planning system, and the business performance management process. So financial results, valuations, and accumulation of long-term value are driven by business performance. But business performance is at the intersection of math and behavioral science. That's why incentives are so powerful and dangerous if you don't know how to apply them correctly. That is because people's future behaviors, desires, and fears shape the financial outlook of every business far more than the choice of strategy or the forecasting model. Statistics and math, on the other hand, are there to guide and think about those things in terms of probabilities. So this leads us to the big question. Is there a reliable way to manage the human element of the unit economics in your current business model and its future outcomes? So let's talk about how to bring human behavior into the equation. Because math alone cannot predict future outcomes, but when combined with the behavioral science, it can. So if a part of your role is helping companies achieve their financial targets and support growth, you've likely reviewed or considered performance-based incentives as a lever for motivation to achieve results. Whether we realize it or not, every line in the revenue and cost structure when you look at P&L or any other financial statement intersects with human decisions. In fact, these numbers depend on it. Decisions like to do or not to do, how much to do, what to do and when, and so on. An example, to buy or not to buy, to sign or not to sign, to ask or not to ask, to call or not to call. You get the idea. As I mentioned before, math alone cannot predict the future, but if you can swing those decisions to the right ones that move you towards the outcome that the business wants, when people are highly motivated to do the right thing, the action or choice that drives the right result, it's often enough. If you coordinate that across the business, it significantly increases the probability of the right result. It may happen the number that you have in your forecast. Motivated people can move mountains, and often that causes both good and bad consequences. So the choices they make in the moment will make all the difference to the numbers that you will see in the financial statements tomorrow. Now imagine if the choice that they're about to make is always aligned with strategy and what looks good for this business, what would the future results look like? After watching different incentive schemes in a variety of businesses over my 24 years, I witnessed how these incentives produce massive differences in human behavior. Some to break in performance records, some to indifference and demotivation, and some actually motivated disastrous outcomes for the business. So if I were to bet on something that I have never ever seen fail, is that people will always do what benefits them. Sometimes they will consider the wider consequences, but it's unlikely that they will change their choices. So if you are interested in keeping people accountable, making sure that they are doing the right thing and acting to maximize the numbers you'll see at the bottom of your P&L at the end of the next quarter, then the science behind these choices should be interesting to you, because it determines the targets that you set and the reward system to motivate these people to work hard to reach those targets. These are the best levers to make your forecasts come true. The right incentives can create cooperation and strong relationships, or they can breed stress and anxiety. As I said, I've seen both. And because these things have momentum to them, sometimes if you start creating the wrong situation, it spreads really quickly. That is because this reward system connects to our internal reward system, and they tap into deeply emotional drivers like desires, fears, greed, and most of all, uncertainty. So incentive structures are in place to impact business performance by creating motivation to achieve certain results. And the practical application of that is this. There are two types of numbers that I use for incentive schemes. One is result-based criteria, like revenue, sales, CSAT. These are the outcomes that are influenced by many factors. A lot of these are beyond the direct control of people who are rewarded based on those. So as a result, when the numbers look good, it may have nothing to do with that person's efforts. But when we know that we get rewarded on that basis, when the number grows, we settle into comfort. But when something changes, it's too late to affect the numbers. And when something opposite happens again, because economy may change or whatever, and the number is actually reducing. So the person would feel, well, it doesn't matter what I do, the number's not going to change. Again, both situations are not good for the business performance and such. But if you use the performance-based criteria, the numbers that you are looking at are actually tied to actions that these people take. Result-based incentives are actually detached from the deep motivation to get the job done right. But performance-based criteria, performance is the amount of result per effort. When we're looking at things like number of requests handled, number of meetings booked, number of presentations had, because performance numbers heavily rely on attention, habits, focus, they tend to help with cooperation and create a challenge mindset rather than victim mindset or the winner takes all mindset. Monetary rewards is not the only way to go about it. There are many ways to reward people. So the food for thought here is, what if we shift from rewarding results to rewarding behaviors and rewarding it in many different ways, not just with the monetary rewards? Good incentive schemes based on KPIs aligned with the strategy and focusing on behavior that is connected to the numbers that we want to see in our financial statements can create an environment where high performance is simply inevitable, predictable, and on target. To hit your growth goals, a solid financial roadmap is not enough. You need mechanisms that align your goals, incentives, and behaviors that drive the right outcomes. And it's not about creating results by itself. It's about designing the process that will make these results inevitable. From my experience, to manage your end results and business performance effectively, you actually need to have 5 elements in place. Have a full financial clarity, an effective strategy in place, the right performance metrics that are driver and lever focused, not result focused. You need to have the performance-based incentives that support the right behaviors, and they need to be aligned with the strategy. And you also need to have the result-based rewards pool. I tested this with real people in real businesses, and it created massive performance shifts. And not just in performance, but also in business economics and in company cultures. But before we get to more information, I actually want to address some of the questions that I hear all the time. Sometimes we can't implement the right frameworks and the right systems in the business because we think that something is stopping us. And the question that always comes up is why anybody would listen to me? I'm an external, I'm just a finance person, or I'm not a CFO, or I am not there yet. Whatever is stopping you, let's look at the opposite question. Why wouldn't somebody listen to you? If you can talk about something new, something interesting, or if you can ask a question, these three things would direct attention to you immediately. So, okay, you have access to all this financial information that you are sitting on. Why don't you find something new for them and show how that connected to the behavioral drivers and to the levels in the business and the entire business model? If you show how that affects results the person wants to achieve, they're surely going to pay attention. You don't have to have a permission for that. If it's something new they have not seen before, they will look at it. I can guarantee I've done it so many times. But then you can also make it interesting for them. Why would they look at it? Well, is it interesting? It's interesting is when it's something that either helps them or stops them or in some other way influencing what they're trying to achieve or preventing them from that. And we are wired to answer a question. But imagine if you ask a question that is new and is interesting. So now they be 3 times as engaged and as interested to listen to you and talk to you about it. Once you start the conversation, you're moving from the historical assumptions to using the statistics, strategy, and the people in the business. So affecting those decisions, affecting those actions. And if you incentivize them correctly, the probability of the right outcome really goes through the roof. Another question is, I don't have time. When should I start doing this? And my question is always, when's the best time to plant a tree? Well, 20 years ago. When's the next best time to plant a tree? Today. And moving into the next financial year, right now is the best time to start looking at everything what you're doing, at the results in the business, your financial plan for the next financial year, your quarterly targets are aligned with the drivers and the levers, not the historical constraints the company had to deal with before. January is the best time to have new budgets in place, new targets in place, new KPIs in place, to have better metrics and refreshments to your reports, and also employee performance goals or client performance goals or business performance goals. And also it's the time to figure out what that business wants to be at the end of the next financial year and what is the plan to get this business to that point. Because if we know that, we can put together a great financial strategy with the milestones, supported with the right incentives, supported with the right actions, and working on the right priorities and things that the company needs to do to be exactly where the company wants to be at the end of the next financial year. And what's in it for you? If you are able to help the business to get where the business wants to be, your value now is connected, not with the cost line in the P&L, where they know exactly how much you cost this business, either through fees or through salaries or other rewards. If you connect what you do to the results that the business gets, your value is immediately measured to the improvements, to new revenue, to new profits, to improved margins. And as the results, your monetary reward suddenly totally makes sense. If you're helping to grow the pot, your share of the pot can be bigger. Grow with your business, grow with your clients, grow with your employer, grow with the opportunities that you have.
If this helped you see how you deliver value in your business differently, you'll love what's next. Subscribe to my weekly newsletter at impactstrategy.club and let's build your financial strategy together.